We pride ourselves on understanding real estate to a degree, but also understanding the trends in real estate. And I think you have to be current. As a senior debt lender, you have to understand what's going on. Depending on if it's a developer or investor, whoever it may be, we want to understand whether they've got evidence to back up what their business plan is. And it's basic stuff, but you'd be surprised how many times you see a spreadsheet and actually the numbers don't add up.
Really?
Senior debt is the lowest returning part of the capital stack. We don't share in the upside that the equity gets if something goes right. I continue to worry about the office market, but at the same time I see it as a huge opportunity. I'm not even convinced that most lenders probably do 5-year loan terms any longer. It's probably 3 years. So there's this recycling of debt every 3 years.
Peter, welcome to the pod.
Thank you for having me.
Not at all. Well, look, I'm really excited to find out a little bit about your background and talk about Leumi and how you see the market and where the opportunity is today. But as you know, a place that we always like to start these conversations is how and why did you get into real estate?
I think, like a lot of your other guests, I ended up there by accident. So I went to university, studied a degree in colouring in, and which effectively was a degree in geography at Durham. I didn't really know coming out of university what I wanted to do. I guess I'd not been a natural academic, didn't come out with the results that I wanted potentially. And all my friends were off to do, I don't know, be a solicitor, accountant, top four, investment banking, that sort of stuff. And I didn't get those grades. So it was sort of, where do I go?
You must have been academic of sorts to get to Durham, though.
I think my academic career got worse and worse as I got sort of older and older. So I think at the age of 11, I was probably quite bright. By 21, I wasn't. And maybe I dulled that down with a little too much alcohol at some point at university. But yeah, I was okay. Like, I was relatively studious at school. I got reasonable A-levels. I probably found university a bit boring, if honest. I actually enjoyed the holidays more when I got the opportunity to work. And actually that's probably been a theme that I've been able to carry on, in that I enjoy work. So anyway, going back to your question, how did I get into real estate? I did this 2-week work experience, one summer holiday in university, and it was for a neighbour who was a chartered surveyor. He was a 2-man band. He was a specialist in licensed trade properties. And I grew up in North Yorkshire. And it's fair to say most of the assets he looked at were pretty grim in and around the north and the northeast. So we saw, I was the designated driver for 2 weeks. We saw a whole host of different assets, most of which you probably wouldn't want to go into when it was open. But it was an eye-opener and I enjoyed it. And I guess at that point I got to understand what cash flow was. So I had a very early insight to understand what cash flow did for an asset and how it created value. But it wasn't some sort of light bulb moment that this is what I wanted to go and do. And in fact, I actually applied to do a graduate program at an outfit called Majestic Wine. I loved it. But I very quickly realised that I had no nose, no palate, and actually talking about wine all day wasn't what I wanted to do.
Just weren't interested in it.
I enjoy wine and I enjoy elements of it, but not day in, day out. Great for a hobby, great to do when you want to go down to France, you know, to some of the vineyards or even southern England, but not day in, day out. And actually, to a large degree, I was a glorified van driver for a lot of the time. I worked on the Pearly Way branch of Majestic Wine for most of the time I was there, delivering wine to a whole host of different people, some of which were relatively famous. In fact, one of our biggest accounts was the Ann Summers head office, which was interesting. But I quickly realised it wasn't for me. So I was back at home over Christmas. I was chatting to a friend that I've been at school with, and he said, look, there's a role going in the local Bradford and Bingley bank as a credit analyst within their property finance team. Would you be interested? well, why not? What have I got to lose? I didn't at that point really know what the role meant. There wasn't a job spec per se. But I got on with the lad that had suggested it, and he worked there, and he said it was good fun. And I thought, I've got to try something. And that was that. I applied, and I went through a really bizarre interview process as well. So I had to do an English test, I had to do a maths test, and I was okay at both those subjects at a school level. So, got my GCSEs in both of them. Turns out that I got all the maths questions right, but did them really slowly. So I only completed half the test, but they liked the fact that I was diligent. So got the job, and actually never looked back. And that was it. So that's almost 20 years ago.
And no friends or family in real estate?
They are now, but not at the time. No, my parents ran a marketing business, so nothing to do with real estate whatsoever.
Hence, you're trying to work out what a credit analyst did at a bank, right?
Yeah, absolutely no idea. I mean, credit analyst to me was sort of a mystery. I didn't really know what to expect, albeit I was sort of sold that I'd be able to go around and look at loads of different properties. And I guess it was that piece that I was probably interested in, but I didn't even know I didn't really understand what a surveyor was at that point in time. I'd not vested perhaps enough time and energy into what are the possible jobs out there that you might wish to follow.
I think it's really hard. I think it's still hard right now, let alone however long ago you got into the industry, right?
Completely agree. And actually, I have a 12-year-old and a 9-year-old, and I look forward to when they're entering the world of work and thinking there are so many jobs out there that they have the options to go and do. But I wasn't aware of any of that when I left university, despite the fact I, had a reasonable education, grew up in a reasonably nice area with people doing lots of different things, just not paid an awful lot of attention. I was probably prioritising other things like sport.
So was it a bit of a wake-up call when you kind of landed as a credit analyst, kind of going out and looking at these properties and then trying to underwrite them or work out whether you should lend against them or not?
Yeah, absolutely. So the specific role was I was to be the bridge between the front office loan originators and the credit function. And they didn't sit in the same office. So,
and just for context for people listening to this who aren't familiar with those terms, can you just explain them? Because no doubt later in our conversation, that additional context will be useful.
In the world of real estate finance, you have originators or front office, which is effectively the people that are in the property marketplace, knocking on the doors of property companies, property developers, etc., seeing whether they require finance and funding for investments or developments that they're wishing to do. And then you have a second line of defense, which is your credit officers and your credit team. And it's those people that ultimately will analyze and opine on the deals that are being, or the loans that are being put forward. And so I was this, it was a slightly unusual role, but I was this sort of go-between between front office and credit. And my job was to do a lot of the analysis up front on the loans that were, or potential inquiries that were landing on the desk.
Just to see if it needed more, further DD, or is worth other people's time to spend on that particular potential deal.
So the originators tend to be the ones that get paid the money. So if they're sat at their desk analysing a deal, they're losing an opportunity to be out in the marketplace knocking on a door. So why not pay someone that seemingly can add up and use a computer and do a bit of research to do some of that risk analysis? It was very much that. And in today's world, that would be an analyst at a clearing bank, or it would be at a PE house that does debt, etc. So, the role exists today. I think the only difference at that time was that I literally carried the bags for the originators. There was a lot more files to carry around. There was less, computer loading of data systems, etc. So, it was an interesting time.
And so you were there for nearly 3 years?
Yeah.
In the run-up to the credit crunch.
Yeah. So I've heard quite a few of your previous guests talk about the GFC as sort of a moment in time in their careers, and no different for me, really. I think the writing was on the wall when there was a run on Northern Rock, and Bradford and Bingley was run by a chap, or the property finance team was run by a chap called Simon Wilkinson, who I think is probably one of the best leaders that I've had the fortune to work with. And he tapped me on the shoulder and said, look, I think time's up. I think the game's over. You didn't hear that from me, but you might want to have your ear to the ground. And actually, the head of the team at Bradford and Bingley had just left and gone to Alliance and Leicester, which was like the big sister of Bradford and Bingley in terms of that part of the market. You know, it was both were demutualized organisations that had become banks, and the head of the Bradford and Bingley team, Ray Ellis, who still works in real estate finance for Aberdeen, he tapped on my door and asked if I wanted to come across to Alliance and Leicester. And to me, it was a no-brainer. It was moving with someone that I liked, respected, and had spent a lot of time working with. I didn't know where the world was going. No one knew where the world was going at that point in time. That there appeared to be people on one hand saying everything will be all right, this is a moment in time, and then on the other hand, you know, there was a run on a bank, and we all know what's happened since.
So that was October 2007. So you moved just before really the market fell away, effectively. So you landed a new job, started, and then a few months later.
Yeah, I think if memory serves, Alliance and Leicester had to tap on the Treasury's door in November and ask for a £3 billion credit line. So, to be honest, it's a bit of a surprise that I maintained a job, because I was probably still on probation.
Yeah. And probably fearing last in, first out.
Yeah, exactly that. Yeah. But for whatever reason, that didn't happen. And I think we didn't do an awful lot of business in that first few months, as you can imagine. You know, there was a lot of sort of navel gazing or sitting on hands. But it was a good little team, actually. The Alliance and Leicester team was newly formed. The previous iteration of that team had departed. And actually, it created then a platform for when Santander came in and bought that business. There wasn't a huge legacy loan book that was causing big problems. There were loans that we needed to sort out, but there wasn't a real dramatic need for us to worry about particular clients. And the business hadn't been doing highly levered 100% funding of costs, which many others had. So yeah, it was an interesting time. And, you know, Santander came along, ultimately negotiated hard with a number of different entities in the UK, but bought Alliance and Leicester to plug into the business that it already had with Abbey. And that was the start of, I guess, a run for me. I was lucky at that point. We had to reapply for our own jobs, but that worked out in my favour. So.
And how did your role change over that run of 10 years or so?
Not so dramatically, really. I think at that point, the role was always tagged as a director role, and I was doing loan origination by that stage. So at that point in time, you know, my role was that I was already speaking to clients. I was trying to encourage them to show me transactions that I could fund. I guess the only thing that really changed was that I was able to knock on a lot more doors with the knowledge that there was capital behind when Santander decided that it was ready to go and deploy and grow in the UK.
And so you had that, you know, that badge and I guess the badge of Santander behind you, right?
It wasn't a badge, actually. It was a tie, a red tie. Everyone got given a red tie. And actually, you knew your seniority in Santander based on which colour shirt you wore.
Really? Old school?
Yeah, it was old school. So if you were junior, you wore a white shirt. If you were relatively senior, you were lucky enough to have a blue shirt. It wasn't a uniform.
I was going to say, was it kind of given to you on day one?
It wasn't a Santander suit and shirt tie combo, but it was very much, you knew who you worked for, and this is our this is our branding. This red is our branding.
This is what you do.
Yeah.
Go and wear it with pride.
And way betide you if you lost your tie, which I obviously did.
So what kind of deals were you involved with at Santander then?
Funnily enough, quite a few of your prior guests are people that I met when I was at Santander. So we did a whole host of different things. It was mainly senior debt. So I guess for the benefit of those listening that didn't hear the Rod Lockhart podcast, senior debt is the sort of less sexy end of the capital stack. It's the least risky. It's the one that generates the least return, but it's also the safest, or supposed to be. So we were doing senior debt transactions. We were working for effectively a high street clearing bank. It was all relatively simply structured. You might do lending against a retail park, say at 60% LTV with some amortization. And it was relatively formulaic, relatively straightforward. The differentiator at that point of time was not necessarily the product offering, it was the fact that we had money and others were still dealing with the fallout of the GFC.
So you could get around and you could offer quite favourable terms on your basis because of you had the money and ability to transact relatively quickly.
Yeah, those investors and developers that had withstood the GFC, had money, had capital, lots of opportunity funds at that point in time, it was pushing an open door. So, real estate finance is not rocket science. It's a people-driven business, a bit like the rest of the property market. You go in there, present yourself, in a reasonably credible way, explain what you can do, and you hope that there's a reciprocation. And at that point in time, there was plenty of people with capital deployed. There was plenty of people that had actually traded out pre-GFC and had money and had hoped something along those lines may happen. And that presented opportunity. And then there were those that were lowly levered and were having tricky conversations with their existing banks because their existing banks had a whole host of different things going on, but it was easier to get their money back on the lowly levered stuff because actually that's tradable. There's liquidity in that space. So we were able to have lots of conversations with lots of different people. But there were some interesting deals along the way as well. There were some deals that you look back and go, crikey, today might not do that. We funded a vacant care home. I'm not quite sure why, but we did. And actually, they got planning on it. It got converted to resi. It worked out okay. I'm not sure I necessarily want to fund a vacant care home without planning today. We had a bit of luck along the way.
And care homes, student accommodation, office, retail, industrial, was it a full suite across the board in terms of the sectors?
Yeah, more or less. I think it's interesting. I think the market's moved on considerably in terms of the adoption of alternative sectors today to what it was back then. Our bread and butter was the traditional commercial sectors of industrial, or everyone says industrial, I mean, it's really logistics, retail. And retail at that point wasn't a dirty word. Retail actually was still quite a buoyant market. And we did quite a bit in the retail space and offices. And again, that wasn't a dirty word either. So, we did quite a lot of that. And then a bit of residential and probably a bit of student accommodation as well.
And so you kind of climbed the ranks over 10 years to relationship director, is that right?
Yeah, so there were sort of two bandings within the relationship director space. I guess I was probably at the slightly more senior one. I had a great time there and I loved it. But after 10 years, you look around and you realise that most of the people that you were working with 10 years ago aren't here any longer. There was a colleague that I was working with at the time, and I think we looked at each other. We're working quite closely. We looked at each other, and we sort of realised, I think, that both of us wished to move on, and whoever got to go first then got gardening leave. Annoyingly, he went first.
He went first. Yeah, what an interesting way to kind of decide your next career move based on who goes first and who gets 3 to 6 months in the garden.
So I wasn't. It was an interesting time. I wasn't actively knocking on doors looking for a new role, But I guess over the course of my career, I've sort of tried to take opportunities where opportunities have presented themselves to me, rather than necessarily proactively going after certain things. But at that point in time, Ray Ellis, who I'd have worked with at Bradford Bingley, worked with at Alliance Leicester, he'd been at Santander for a bit. He'd then moved to Lloyd's. He knocked on my door again, and it felt one of those points in time where we'd worked really well together for a number of years, and I'd grown up under his sort of wings to a large degree. A lot of the clients that he'd introduced me to originally had become my clients, and he was running a little team at Lloyd's, and it was kind of a natural place to go. It wasn't the Lloyd's badge particularly. It was the fact that I felt this was probably one more opportunity to work with Ray, as well as move to Lloyd's and see what Lloyd's was about. Having been at a clearing bank for 10 years, did I automatically want to go to another clearing bank? No, not necessarily. But Lloyd's at that point was probably the largest real estate finance platform, in the UK from a clearing bank perspective.
Can you just say, for people listening, what is a clearing bank?
Yeah, okay. So, good question. I'd say there are 5 main clearing banks in the UK. But ultimately a clearing bank, and those clearing banks are HSBC, NatWest, Barclays, Lloyd's and Santander. To all intents and purposes, it's where businesses run their money through. They provide a proper banking service and they clear their money through those banks. In the UK, they're typically high street lenders, high street banks.
And that's through their commercial arm rather than their retail arm.
Through their commercial
GFC
arm.
Split up.
Yeah. I won't bore you with the complications of regulation around post GFC, but yeah, there was a large amount of regulatory oversight that meant there had to be a division in terms of how you split up your banking operations.
Yeah.
Between what would effectively be, the investment banking side of the equation and the retail commercial side of the equation, and each of the banks did it differently.
So you thought it would be a good idea to move to Lloyd's, work with Ray, get some further experience.
Yeah, so Lloyd's were doing stuff that we couldn't do at Santander.
Because they had the remit too? Or?
Yeah, it was probably a slightly more mature business, really. Lloyd's is, it's been around for such a long time. It has such a history in the UK as a business that actually the client base that it has as a real estate finance platform was phenomenal. It was, Santander probably will get there one day, but it probably doesn't still have the client base to the same level that Lloyd's has had. But that's a historical thing. That's a legacy that Lloyd's has been able to achieve over a very long period of time. But there was a chap running that business called John Feeney. John Feeney is quite an enthusiastic Irishman who speaks about 5 languages and is very focused on driving business performance. And I was enthused upon meeting him and others that worked in the business at that time, and wanted to go and join it. Yeah, and I spent 3 years there. I reapplied for my job 3 times. It's a unique organisation that I really enjoyed working with. Has phenomenal people, but realised quite quickly that I wasn't going to stay there forever. I realised that I hadn't necessarily moved enough from Santander to Lloyd's to get a better diversity. There was some diversity in the role, but there wasn't enough.
It's kind of doing a similar role in a different shop,
yeah,
and just needed something that's going to stretch or grow you or challenge you.
I got a bit of exposure to some stuff that I'd not had exposure to before. So I was asked to move across to look after the listed client or part of the listed client portfolio. So I ended up working with some of the large UK REITs, which was interesting, and I learned some stuff there, and I look back and think actually that was great. I got to meet some unbelievably senior people within the listed space in the UK, and felt, and again it goes back to that point I made earlier about people. Actually, all the way along, I've really enjoyed meeting the people that do the deals and create the businesses and formulate the plans, etc., and then execute them. And it was another opportunity to meet another breadth of people, which that was probably the piece that I really took away.
You then moved to Leumi in April 21. That post, COVID thinking, opportunity, shaking, and just an opportunity to kind of move for a bigger role and a more flexible remit.
Absolutely. COVID was brutal. So I was living in a household with 2 young children. I was working. My wife was furloughed. She was trying to do childcare, teaching, you name it. And I felt like it was relentless, working all hours just to stay above water. And I think that was a common theme throughout the UK. Those that were working relentless hours on Zoom calls or Teams calls or whatever. And again, it wasn't a case of me looking for a new role necessarily. I liked Lloyd's, I liked the people, I enjoyed the work. But again, I got a tap on the shoulder. So it was a previous boss that I'd worked with at Santander. And he said, look, we're looking for a head of property finance. I said, well, you're looking at him. Where can I sign? I'd been an originator and a relatively senior director in 2 different organizations. And I was ready for a fresh challenge. I was ready to do something a little bit different and actually come full circle back into a much smaller business in the UK. Now, Leumi is not a small business, full stop. It's part of Israel's largest bank, but the UK business is small. It's 120 people, and it's very, very different in terms of mindset, culture, to what I'd had at Lloyd's and Santander, and I love it. It's great. It's a breath of fresh air. I feel reinvigorated in terms of my career and the ability to create something, relatively special. I think we're developing something special.
So what was the kind of the vision that you were sold or told, or the journey that you were coming on to bring alive effectively?
Yeah, good question. So at that stage, the UK organisation for Leumi was a bank. I was expecting it to remain a bank, but very much the story was central to our business going forward is property finance. And we want you to grow the balance sheet materially in the UK. And within 3 years, we want you to double that. Double our existing balance sheet, which at the time was roughly $500 million of loans under management. We managed to do that. We managed to grow our balance sheet. But there were a whole load of stuff that's come along and sort of got in the way or helped us, or whichever way you want to put it. But at the time, and it wasn't part of the story, but I think in the CEO's mind was we were going to hand our banking license back, and we were going to become effectively a credit fund, albeit a credit fund with one line, and that line is provided by the parent company.
So to be crystal clear then, banking license over here in the UK, but the idea is to hand that back and use the bank's balance sheet as a single source credit line, and effectively just decide on a deal by deal basis what you want to lend against, for how long, on what terms, and you could be quite opportunistic in terms of the deals that you looked at. That's
it in a nutshell. I couldn't have said it better myself. So for any small bank in the UK, regulation pressures post GFC have only increased, and there's a cost attached to those pressures. Now, the decision making around handing the banking license wasn't solely to do with regulatory cost, but it definitely has an impact, and it meant that we could focus on what we were good at. So we didn't have the burden of looking after bank accounts, which, for anyone that's worked in a clearing bank will know can be a little bit difficult to deal with. We had the ability to go and focus solely on lending money and using our parents' credit line that they provided us to go and deploy their funds into the UK market in the knowledge that they actively wanted to grow the platform here. And yeah, absolutely opportunistic. So I guess our cost of capital means that we sit in a slightly different place to the places I've been before. So we're not necessarily actively in the same space as Santander or Lloyds, albeit we will compete with them on transactions. But we're also not where the debt funds are, who have a higher cost of capital. We're somewhere in the middle. And we think like a bank. So it was it felt like a slightly unique proposition that we've been able to present.
So low cost of capital, entrepreneurial mindset, quick decision making on particular deals meant that you could be very competitive and also get a lot of money out into the market on the terms that you felt comfortable with, and you could manage and mitigate risk appropriately across sectors, geographies, etc.
Yeah, so how the real question was, how do you build a business that's sustainable, but at the same time really quick and flexible to the needs of the people that you're talking to? So how do you set up a scenario that means that if someone comes to you and says, I've got a transaction, I need to fund it, I've got 4 weeks, how do we get it across the line? But we're not a bridging company. So we want to do longer term transactions where, you've really got to understand the risk and the profile of a transaction in detail, but quickly. And perhaps with a slight degree more flexibility than certain other lenders that aren't charging as much on their margin as we need to do to make a return. That's been a challenge, but I think where you focus your attentions is on the team. And when I arrived, there was a team of 7 people. We're now at 17. And out of those 7 people, only 3 of the people in the team now are remaining. Some people have departed. But what we've really focused on is culture. How do you create a culture where people recognize that they've got to work hard, be slightly creative as creative as you can be in a senior debt space, but try and match the aspirations of the business and grow and have determination and dare I say it, resilience, because who knows who Leumi are? When we started this journey, I would say that lots of people hadn't heard of who Leumi were, probably still haven't heard who Leumi are. But we've been able to dispel some of those myths. We've been able to present that, the majority of us have worked in this industry for a number of years, have experience of how to structure loans, but forge incredible relationships with our credit team to be able to get to quick answers and deliver on what we say we're going to deliver. And that has been the bedrock to our success over the last 3.5, 4 years.
And it is all senior loans. That it's not mezz or pref equity.
It's definitely not mezz, and it's definitely not pref equity. But there's a blurring of lines between what the world likes to now talk about as whole loans. I think, actually, Richard Croft talked about it, didn't he? In terms of gap funding, there is a gap in the funding markets. No two ways about it, and some of what we do plays to that gap. We are senior debt in mentality and in terms of return profile, but where there's an opportunity to de-risk a scenario and present perhaps something that might more look like a whole loan, i.e. a little bit of extra leverage, or perhaps a little bit of extra risk on certain profile of or certain aspect of a transaction, we'll look at it.
Because you've got the flexibility, you've got that entrepreneurial mindset, and you've got one LP or capital source that can take a view in comparison, or looking at the wider book and the risk that you've got out in the market.
Yeah, and absolutely. an entrepreneurial view for sure, but also our decision making is here in the UK. So there are bits of it that need to go to Israel, to our parent company, when the deals get to a certain size. But the bulk of what we do is here in the UK, and it's decision making by people who are experienced in the UK.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People, Property, Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. So how big's the book at the moment?
Good question. So we're about 1.3 billion of assets or loans under management, but that needs to grow.
And in terms of the kind of the sectors and the size of tickets that you write, can you share a little bit more around that information?
Yeah, sure. So sector-wise is an interesting one. We talked off mic and off camera about the fact that some of our success has been born by the fact that we want to adopt a slightly contrarian or counter-cyclical view on the marketplace. You know, if I look at one particular sector, which is retail, some of our best performing loans over the last 2-3 years, post Liz Truss's disaster of a government and budget, has been in the retail space. And I think some of that is because retail's rebased, you know, rents have repriced, that, you know, people that were holding decent quality stock have managed to repurpose them where needed to, or replace them in terms of tenants, whatever it may be. And when you get granular on the analysis of that information that can flow from those sponsors that own those assets, you can really get under the skin of the income profile. You can really analyze trends. You can work out where the risks really lie. And I think what we've seen is that we've really benefited from saying, actually, do you know what? We'll look at anything. We'll look at anything so long as we can get the data, we can analyze the risk, and we really believe in the sponsor and their strategy. So from a sector perspective, we'll look at all sorts. I mean, we did a dry dock in the Thames Estuary, which was a fascinating deal. It gave off loads of income, but you had to really understand the risks attached to it. And the risks were plentiful, you know, flooding, for example. What were its ESG credentials? You looked at it and you went, this looks horrific from an ESG perspective. Actually, our client, they ended up selling it to an ESG fund because it had loads of recycling on site. And we'll look at that stuff. Whereas I think a lot of sort of more traditional senior debt lenders probably won't.
How do you bucket risk then in terms of, you know, exposure to one particular asset class or sector?
Yeah, so we have limits. You know, we have limits. We you know, my job and our head of credit's job are to manage our exposures to geographies, sectors, sponsors. So we manage all of that. You know, we keep obviously all the data and what have you in relation to all of our loans, and we're constantly analysing that risk, and we're constantly managing those limits. But that's really no different to anyone that's in the real estate world. Your job is to manage risk, whether it's at the equity end of the spectrum or the debt end of the spectrum.
And I guess managing that risk is at the asset level, but also the sponsor level as well.
Yeah, of course.
Can you just talk to me about what you specifically look for, both at the asset level and then the sponsor level? Yeah,
I could try. Asset level, well, I'll start with asset level, because I think it's really, really difficult to necessarily dictate what's good and what's bad for different types of lenders. What we look for is solid bricks and mortar, I think is probably the best way of putting it. We'll spend a lot of time understanding the nature of the building, where perhaps something doesn't work or where something doesn't work, and then where its geography is. Is it connected via transport links? Has it got an income profile that's been sustained over time? Or actually, is it losing income? Why is it losing income? So there's an awful lot of aspects to a property that we'll look at. But I think over time you understand that property needs capex. It needs money spending on it. If people aren't prepared to invest in their properties, then the chances are your security as a lender isn't going to withstand the test of time. And that's something we look really hard at. We really want to understand where's money been spent, how's the M&E on an office building, what money's been spent on that M&E, when was it done? Was it done by the professional parties? If someone's done a report on the M&E, what does that look like? What does it actually tell us? So we go into quite a lot of detail around the underlying asset, and obviously we use third-party professionals to validate some of that. But as you rightly identify, that's one side of the risk equation. The other side of that risk equation is your client or sponsor. And depending on if it's a developer or investor, whoever it may be, we want to understand what their experience is. We want to understand what their business plan is. We want to understand whether they've, got evidence to back up what their business plan is. And we need to be able to validate it. We need to be able to work through the numbers and understand that the numbers all add up. It's basic stuff, but you'd be surprised how many times you see a spreadsheet and actually the numbers don't add up.
Really?
Yeah, sometimes. Yeah.
From credible, operating partners or sponsors.
Not normally the credible ones. Normally the credible ones are pretty good, but even the credible ones, we all make mistakes, and sometimes there's an explanation because someone's changed something in a cell over here. But our job is to analyse that risk and make sure that we don't miss it. Senior debt is, as I said at the start, it's the lowest returning part of the capital stack. We don't share in the upside that the equity gets if something goes right. But you can have nasty mistakes if things don't go right. So, two things that we really, really analyse are fundamental to us as a business are being paid, and on being paid on a recurring basis, and also being repaid. How are we going to get our money back? In fact, it was Simon Wilkinson at Bradford and Bingley on my very first week working in real estate finance who said, remember, this is your pound. You need to get that pound back. And I've not forgotten that.
And so you're looking at how quickly you're going to get it back. What's the recurring payments? And are we going to get it all back? And then if it all goes tits up, what's the flow off? Or how obviously as a senior loan, you get your money back first, but how is that asset going to play out? And
so I guess when we're looking at recurring payments, so let's say we lend for 5 years on a retail park, which is fully let, good secure income to a suite of tenants. We will look at the quality of those underlying tenants, analyse the risk of their performance over 5 years to know that they're going to continue to pay their rent. And if there are lease events within that period, what's the underlying dynamic of the market for that particular asset in that particular geography? And we'll spend a lot of time looking at that and working out what that means. And then during the period of a loan, we will analyse the statements that come in to us from a sponsor around quarterly performance of rent. Are there any arrears? If there are increasing arrears on a portfolio, it's probably a telltale sign that something's not quite working. Well, we need to know why. to all intents and purposes, we're a joint venture with our sponsors.
And the tenant. It's like a three-way JV in a sense.
A little bit, albeit we don't have a relationship with the tenant. That relationship's held by your sponsor normally.
But the sponsor's reliant on the tenant as you are to paying, and wanting to set their business up for success so that they're profitable and they can pay them a return and you as well. So it's like a three-way dynamic.
Absolutely. And our sponsor and ours need to be comfortable that those tenants are going to pay. I guess because we're thinly paid on a return over time, we don't want there to be a scenario where there is a mistake made. We don't want that. It happens, but we want to minimize that risk as much as possible. And then when we want to look at getting our money back at the end of 5 years, we analyze the ways in which that may happen. I mean, the two obvious ways are either a sale of the asset or a refinance elsewhere. The third way is that you take control and
loan to own.
Yeah, well, loan to own, yeah, murky ground.
Yeah, which is not ideally what you want to do, is have the asset on your balance sheet yourself.
No, and we wouldn't, I don't think. At a senior debt perspective, there's normally sufficient headroom between, value and our loan amount to give us headroom to allow a sale of an asset. And I wouldn't say we war game that, but we certainly a scenario analysis around drop in income over here to what impact that has on value. Yeah. To then dictate where we might be in 5 years' time. But it is a little bit of finger in the air sometimes. You are reliant on market movement, and that's the same in whichever part of the capital stack you play.
Risk mitigation and just trying to manage it as best you can, and going in going in trying to mitigate your risk and try and box off any sort of scenarios that may appear, so they're not surprises later on.
Yeah, and I think it's really important for us to educate ourselves. So, we pride ourselves on understanding real estate to a degree, but also understanding the trends in real estate. And I think one thing that we as a business really wish to sort of hone is how we stay current. How do we stay on top of what's going on across the various sectors? So if we say we're sector agnostic, you still have to have a pretty good view of what's going on in the different parts. So we spend a lot of time attending seminars, hosting our own events, having round tables with people to educate ourselves on the marketplace. You have to be current. As a senior debt lender, you have to understand what's going on.
There's a lot of, in the last couple of years, post Trustonomics, as you alluded to earlier, there's a lot of individuals that have set up new shops, operating partners. How do you get comfortable with those groups who maybe don't have the track record under insert new brand name, a few partners, or is it more about the individual's personal track records at the previous businesses that they've worked at?
That's a great question, because I think it's really easy to say, oh, you're a new vehicle, we don't want to, we're not interested in dealing with a new vehicle. It has to be about the people. We will spend time with individuals to understand them and how they think. How do they formulate a business plan? So it has to be around the track record of the people. Just because a new venture has been formed doesn't mean that the individuals per se don't have a track record. But I think that's only one half of what your question is. I think the other half to that question is, how do you get to understand the different capital flows? Because there is so much capital from all over the world coming in and going out of the real estate market, that how do you understand which are the ones you want to deal with, which are the ones you can deal with, which are the ones that are going to stand behind and be here for the long term? That's harder. That's a lot harder. But again, we have to a large degree, use some of our judgment, but also try and inquire and understand what that's about, who those people actually are and where that capital is coming from. And is it a meaningful amount to that particular capital provider, or is it a drop in the ocean and therefore less meaningful? And those things do have an impact.
As a business, do you tend to do lots of one-off spot transactions with lots of different managers, or is it a case of build up a relationship with groups and do multiple transactions within that group? And I know there's an efficiency play and probably an ideal, right? But to a point.
I'm smiling because this is the great conundrum, because the easy way is to do lots of deals with the same people and hope that it all pans out. It's actually a balancing act, and it has to be a balancing act. We want, like any investment manager, we want to have a balanced portfolio of loans. We want to make sure that we've got a good breadth to what we do. But we love repeat business. You can't build a sustainable business if you don't have repeat business. And therefore, we're really focused on that. In fact, so when I joined Leumi 3.5 years ago, I'd never run a team as that before. I'd sort of, I guess, been a senior figure within a team and sort of understood what it was to sort of lead a small cohort of people. But I walked in not really knowing where we were going and how it was going to come to pass. But I said, there's a really clear message. If we want to build something sustainable, and I think that's really key, we want something sustainable. We want growth, but we want something that lasts the test of time. Then there are certain fundamental things that we have to get right. And one of them is building relationships with sponsors who wish to come and do business with us on a repeat basis. Now, it might be that they do one transaction or borrow from us one time and then repay us and then come back to us a year later with another transaction. That's fine, but that's repeat business, and that's great. And they'll likely tell their friends or peers in the marketplace that we've had a good experience with Leumi. And I think that's the basis on which we've managed to build our platform and grow thus far. We've got a way to go. But the other key point is to have fun along the way. You can't do this job without having fun, I think. So we want people to work hard to build those relationships, but enjoy your interactions. Because if you forge those relationships with people at a slightly deeper level than just the transaction, the chances are you will enjoy it. You will go the extra yards, and you'll provide a better service to that counterparty.
Equity returns on a risk-adjusted basis have been quite tough, and a lot of people have been looking to generate alpha in the kind of credit or debt market. Mm-hmm. Have you seen it become increasingly competitive?
Yes. I've lost track of the number of lenders in the market, and I think we now operate in a world where there is a real blurred line between what's an equity investor and what's a debt provider. I question whether there's sufficient space for everyone to be a debt provider with the rod, on the equity side. But yeah, absolutely, it's understandable because, as I alluded to earlier, there is this gap in the funding market where senior debt caps out, but actually lots of sponsors on their existing facilities, values have depreciated, and the funding that they had originally perhaps is a higher level than they could get today. So there is this gap that needs to be filled, and therefore equity thinks to themselves, why would I not plug that gap? I can earn what, 12, 13, 14, 15% on that gap, which is effectively a secured position. Might be junior secured, but it's secured. So yeah, I get it, but it's difficult. It's a difficult. It's difficult to see that this is sustainable for ever going forward like this. Like something's got to change. I think.
Essentially, I was having a conversation with another leader in the real estate industry earlier this week, and they were talking about it's just unsustainable, just the quantum of even managers or sponsors or operating partners out there as well. So maybe there'll be a little bit of consolidation, or I also firmly believe this year, we saw it last year, but there's going to be much more M&A activity across the board, not just in the listed space, but as businesses hoover up smaller players or merge and they get benefit, and maybe reducing just the quantum of actual businesses operating within a particular space.
I think you're right. One of my neighbours works in the real estate industry on the equity side, and we've talked a lot. I'd say for the last 6 to 12 months, as we've commuted up to town together, we've talked a lot about where does this go? Where do the operators go? How does this manifest itself going forward? And it's really interesting for me because a lot of these people are people that perhaps I've spoken to for a long time and have got great relationships with, and maybe their businesses aren't going to be here if the M&A activity that you talk about does transpire. But one thing I'm fairly confident about is that this is an opportunity for people. We saw it in the wake of the post-GFC. I think we've got the same scenario now. There's dislocation both in the credit and the equity markets. There is an opportunity for people to buy assets that are unfavored, unloved, and apply their skills. There are some really skilled outfits out there. Let them apply them, and if they want debt, then we want to work with those skilled people.
Is there a big debt refinancing wave gonna hit?
There's always a wall. I find it fascinating that there's constant talk of a debt wall.
By nature, if you do a 5-year loan, it's gonna be refi.
So
and if everyone's doing it at a similar stage, there is going to be that wall.
There's this contraction of loan terms. So, I'm not even convinced that most lenders probably do 5-year loan terms anymore. It's probably 3 years. So there's this recycling of debt every 3 years. There's always a wall. The wall's one thing. I think what's important to understand is where the liquidity sits in the credit markets. Who can do what, and who wants to deploy into which markets. And, we talked about contrarian views, etc. I continue to worry about the office market, but at the same time, I see it as a huge opportunity. Whereas beds, sheds, meds, less so. Is that a concern? It seems less so because there seems to be liquidity, both equity and credit side. So I think you have to look under the headline of debt wall, and you have to think about where people favour in terms of what they're doing, and then look at how good the sponsors are that are doing the interesting stuff.
Do you work with debt brokers and advisors to bring you deals, or do you mainly go directly?
Interesting question. Prior to this session, I obviously scribbled quite a lot of notes thinking about what are the sort of topics of conversation that might come up.
And how many have we covered?
Quite a bit, but I wondered whether the conversation around debt brokers might crop up. I think it's fair to say that lenders love and hate debt brokers in sort of similar fashion, and I mean that with the warmest of hearts. There are so many lenders out there now that inevitably debt brokers are required, but it's debt advisors rather than debt brokers. It's people that know how to structure a loan rather than just what a loan property particulars is. That's the interesting part. So yeah, we absolutely use debt brokers. They are a fundamental part of our market. But we try hard to work with the ones that know how to structure a loan. And increasingly there are quite a lot of those out there.
Yeah, rather than be overbroked and under-advised, try and work with the sophisticated ones that are partners rather than just...
Yeah, the interesting conundrum now, as I see it, is that a number of these debt advisors have started to employ in-house legal, and they are using their in-house lawyers as sort of a third law firm on a transaction, which, no two ways about it, means that you are negotiating every square inch of a loan document.
Because you've just got someone internally who's more sophisticated.
So normally you would have lenders' lawyers over here, and you would have borrowers' lawyers over here. We now have debt advisors' lawyers in the mix as well. So
negotiating both sides.
Not negotiating both sides, typically negotiating on behalf of the sponsor, because they're the ones that are paying the bills at the end of the day.
Interesting. Clearly, it's a really competitive market, as we've touched on. Where and how do you see Leumi's kind of USP within quite a noisy space?
Yeah, good question. Ability to move quickly. So we can't necessarily compete in terms of cost with some of the lenders or liquidity in the credit markets that's out there. But what we can do and do well is move quickly. So an example of that was on whatever the first day was back after Christmas period and New Year. We were presented with an opportunity, but the opportunity had to be done and dusted and funded by the end of January. So we had just under 4 weeks to fully underwrite, work through documentation, do all the due diligence, and complete on a facility. And it was 2 assets. It was one in the retail space, one in the office space, for not a new to us sponsor, but someone that we hadn't worked with for quite a long time. And therefore, there was a due diligence piece to get up to speed with them. So yeah, it has to be speed. Speed and delivering on what we say we're going to deliver on. Another example perhaps would be a relatively well documented deal in the mailbox, which I know that Richard talked about when he was on. We had an opportunity there to work with Martley and provide a funding that was slightly outside the box. And, we had to work hard and we had to work quickly to find a solution for those guys and for that asset that was materially de-risked for an asset that's obviously well known.
Yeah, it's been through its challenges, its ups and downs that Richard has spoken about. So in terms of 2025, we're sat here towards the end of February recording this. If we kind of look forward to 2025, what's your take on the market and where do you see the opportunity?
Yeah, that's. I think in terms of the market, I actually don't see that there's going to be material shift in terms of what's underlying in the real estate markets. And I think some of that is dictated to by interest rates. Boring topic, I know, but we haven't seen the rate reductions that we were expecting. The market is not predicting large, amounts of decrease in the curve. It's a relatively shallow curve looking forward, and I think that and a post-budget scenario, which means that there is some distinct lack of growth in the economy, means that we're probably in a slightly tricky year again, which is frustrating for everyone, but is a reality. I think for Leumi, we will continue to do what we want to do in terms of knocking on doors, finding opportunities, potentially trying to play in that little gap that there is, that funding gap, and growing our loans under management. We'll have to see how that goes. It's hard yards, right? There's no two ways about it. For anyone right now, it's hard yards, and you have to work for it, and you have to be resilient. I think it's really interesting that as youngsters are coming into our industry, they have to recognise that resilience is a critical part of your day job. Things will not go right, but it's how you react to it and move on from it. And I think throughout 2025, we're going to have to continue with what we saw in 2023, what we saw in 2024, but let's hope it improves a little bit.
I think even if you work on the lending or the debt side and you work in real estate, you've got to be an optimist of sorts, right? Otherwise, you won't do a deal. So
absolutely, I am definitely glass half full.
Even with your kind of risk mitigation and management hat on, you know.
I leave the glass half empty to the credit officers. Front office is definitely glass half full, and actually, I see there's loads of opportunity. I see there's loads of opportunity for those that are prepared to roll up their sleeves,
outwork the market.
That's the best phrase.
Control what you can control.
Yeah, absolutely. And none of this is rocket science. You know, property finance is all relatively straightforward. If you keep it simple, the chances are it will go relatively well if you do all the right things in the right order. Let's continue to do that and do it really well.
As we draw to a close, the question I ask everyone on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, in which place would you look to allocate that capital?
Yes. People. Can I just take my team? I know everyone says that, but...
Everyone does say that, and I've been thinking recently I need to rebase or reframe the question.
Yeah.
You can have your team. How about this? You can have your team, but you can't have the existing strategy that you have.
That's fine.
So places and property.
Okay.
Outside of your existing strategy that we've kind of spent a little time talking about.
Okay, so strategy, I think, is relatively simple. You know, I know debt. I want to do debt as a strategy.
Yep.
I think there is still space for funding in that space between senior debt and where the equity is, and plugging that gap. I don't think it'll be there forever. I think something will happen in the course of the next 3 to 5 years that'll shift. But I think for the next few years, there's real opportunity in that space and real opportunity to make great returns on asset prices that have rebased. So that's where my strategy is. Geography-wise, I think that's pan-European. So it's interesting. We funded something in Poland recently, and I'd never been to Poland, let alone looked at funding something in Poland. And I think there are pockets across Europe where there's real opportunity. Now, obviously we have certain geopolitics that overlays that side of Europe, but I definitely think there's opportunity on a pan-European basis, and Central and Eastern Europe, there's certain interesting angles that would be worth looking at.
So kind of gap funding in a kind of a pan-European basis.
Yeah, absolutely.
Well, look, Peter, thank you so much for joining me on the podcast today. I'd love to find out a little bit more about your background, experience, and route from tasting wine through to leading a team, executing loans across the UK. So really excited to see what you and the team go on to do, and how you double, triple, and take the book to much bigger and greater things in the years to come. So thank you so much for joining me.
Thank you very much for having me.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show, or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.